Lecture 7, it covers the dividend policies and the different types of dividends that companies end up paying. So we'll go over residual policy, the regular cash dividends companies pay, and we'll compare it also to share repurchases. So before I go through the details of it, I'll just go over an overview of why dividends are damaging. So, people like Warren Buffett don't like to pay dividends because essentially says it damages shareholder wealth. And here's an example of that. So let's suppose you've got a company that pays no dividend and you have a company that pays a dividend. Okay, and let's assume everything is the same for these two companies. And so the same income, same everything. The only difference is their dividend policy. And let's look at it from the perspective of an investor. We'll look at your investment statement at the beginning of the month. So you're going to open your investment statement, and let's say you invested everything. You don't have the cash balance any longer, but you have $1,000 in shares of this company. So your total worth in this account is 1,000, and both will start in the same position. Okay, so you have both scenarios where the company is worth 1,000, or your investments are worth 1,000. Now, the dividend company, let's suppose they pay a 10% dividend. So what's the ending statement that you get for the next month? You'll receive a statement and it'll show you what you have in cash, stock, and total. And in the company that doesn't pay the dividend, nothing changes. Okay, so you have no cash, you have stocks worth 1,000, and your total is 1,000. Okay, so it's the same scenario. So, which is what you'd expect because nothing happened. Now, what about the company that paid the dividend? Now, this company got a 10% dividend, so your share will show, or your statement will show $100 in cash. Okay, now your stocks were 1,000, but they will not remain at 1,000. They have to fall by the value of the dividend that was paid. Essentially, the company lowered its own value by paying out the cash. May not sound intuitive, but let's take an extreme example. What if they paid 100% dividend and paid everything out? Then the shares would be worth nothing and you'd have $1,000 in cash. Okay, so if it didn't fall, life would be pretty easy in finance. You would just buy dividend companies before the dividend and sell them after and just keep making profits. So you could say, okay, well, we're still at $1,000, so it's the same thing. However, not really. This cash is going to get tax, and in Canada, it'll be 35%. So you have tax of 35. So really, the cash that you have is 65, not 100, and your net worth is 965. Okay, so you can see how paying that dividend lowered the value. And the reason people don't see that is, first of all, they don't see the price of the shares fall, because I used an extreme example of 10%. Dividends are usually paid quarterly. It's less than 1%. So you don't even notice it on the trading volume of a stock. And secondly, the taxes you pay at the end of the year, they're not deducted from your dividend. So you don't see those either. So it feels like you're getting free money, but you're not. So that's essentially why Warren Buffett won't buy or won't pay dividends. But in the end, the irony is he buys companies that do pay dividends, because companies that pay dividends tend to do larger, or tend to be larger, and they tend to do better in the long run in terms of their share price. And so if I was to look at why are these dividend paying companies outperforming, it's not because they're paying the dividend, because we just showed that the dividend should be neutral for the company and it should be negative for the shareholder. But the nature of a company that pays a dividend is it's going to be large, it's going to have a stable cash flow, and it's going to be profitable. So if I was to say, anecdotally, let's look at two groups. Group one is a dividend paying company, which are large, stable, cash flow, profitable companies. And group two is smaller, not stable cash flows, and may or may not be profitable, which will do better in the long run? Your common sense would probably tell you that it's the former group. So they're not doing better because they're paying the dividend. It's just the subset is a safer subset. Now, if we look at what is a dividend is a distribution of net income. It is not an expense. Okay, so if you have net income, you can choose to reinvest it, or you can choose to make a dividend payment. There's other capital decisions, which we'll talk about later. You could pay off debt, you can buy shares, but if you're just looking at, the simple operational things, you can say whatever you choose to reinvest is called your retention ratio. So if you reinvested 40%, that's your retention ratio, and this will be a percentage. And the dividend payout ratio is also a percentage. Okay. So keep in mind that this is not an expense because it's already coming out of income. This is a distribution of income. So if you're looking at an accounting statement, where would it come out of? It would come out of the retained earnings. Okay, so your dividend payout percentage is pretty simple. It's going to be the amount of dollar dividends that were paid, and this would be on an annual basis, divided by the net income. Okay, and that'll give you a percentage. So if that works out to 30%, you're paying out 30% of your income as dividends. And the retention ratio is 1 minus the dividend payout ratio.